for the economy
When are you going to
and the environment, and a few other small things.
That aged well. Joining me now, I'm sad to say, even though I love her, Carol Roth. She's the author of many books, but one you might want to pick up pretty quickly here. You Will Own Nothing. Carol, okay, we all woke up today. Everyone made the horrific mistake of logging into their 401k, if they were allowed to do so, and started crying. I don't understand what's happening. I don't understand why it started in Japan. I don't just pretend like I know nothing about the economy. Carol, what happened today?
All right, I'm going to have to dig deep to pretend you know nothing, Jesse, but I'm going to do my best here. All right, so basically this has been going on, honestly, for a few weeks. We had markets that were just soaring to crazy, crazy highs, and that was led by a group of 7 stocks, the magnificent 7 tech stocks. And I think that one day investors woke up and not only realized that they were overvalued, but that in order for all of the AI hype that has been pushing up these stocks to come to fruition, that businesses were going to have to spend a ton of capital to make that come true. And so there was a bit of a repricing, more than a bit of a repricing. We wiped out trillions of dollars of value. Magnificent 7 over the past week has lost about $1 trillion of value. So that kind of kicked things off. Then middle of last week, you had Jerome Powell come out. The investors were hoping to hear that maybe we were going to get a rate cut, even though it wasn't expected, which we did not get. And the table has been set a little bit for September. But then what happened on Friday is we got a really ugly jobs report, and it triggered a recession indicator, which, again, may or may not be a thing. We've had an inverted yield curve for multiple years. But all of a sudden, now the market feels like, oh, the Fed may be behind the curve. We're not going to get this expected soft landing. Things are going sideways, and we ended up with an ugly day in the market. So that's what's happening in the U.S. All of these things on the U.S. side. By the way, on top of it, fears of potential World War III and unrest in the Middle East. So you have that going on in the U.S. At the same time last week in Japan, you had sort of a different dynamic going on. Japan has had negative to zero interest rates for almost 17 years. And 4 months ago, they finally decided to do this tiny little raise. And they, again, on Wednesday, decided they were going to raise again. The yen was weak against the dollar. It was making their imports, their food, their oil more expensive. But they didn't really thread the needle very well. The yen got very strong. And all of a sudden, that kicked off what is calling the Japan reverse Japan carry trade. And basically, in very simple terms, people have been borrowing in Japan because they've had zero and negative interest rates at these very low rates. We've heard this story before. They've plowed that money into things like the yen, like stocks, whatever, shorting the yen, buying stocks, perhaps some of the tech stocks we have. As these things change dynamics, as the yen strengthened in price, as some of these tech stocks decreased in value, all of a sudden what happens? You get margin calls. Oh no, we have to panic sell things. And then once that happens, that kicks off another layer of margin calls and the selling begins selling. And then all of a sudden you had Japan's stock market down almost 12.5% in their first day of trading of the week, or overnight last night, which was the second worst day on record since 1987. So the concern was that we were going to wake up this morning and there was going to be this massive contagion. And certainly there was some. But the good news, if I can give you any good news, because there's a little bit of a silver lining, 2 things here. One is that the amount that we opened down in the stock market, we've recovered some of that, not all of that, but we've bounced back a little bit, which is a positive thing. And then on top of it, we're also up massively for the year. I mean, even with the pullback in technology, the NASDAQ is still, over the last 52 weeks, up about 30%. The S&P 500 up around 27%. So yes, it is an ugly day, and we never like to see these big down days and these contagions, but it isn't, the big bloodbath that I think everybody expected that it might be and was worried that it might be. And I don't think and I hope I'm right, that this is the undoing of everything. I think that this is going to take a little while to unwind, and this isn't it yet. Not to say that there won't be an it yet, but this isn't it yet. So hopefully that gave some clarity, Jesse.
Okay, it did, and it gave some hope. Could you maybe indicate for us why things stabilized a little bit? We were all crying in our Cheerios this morning, and obviously it still hurts. I'm not being dismissive about somebody losing $100,000 from their retirement account, but it didn't continue free falling all day. Why? What happened?
Well, I think a lot of these sophisticated investors understood that more of the catalyst wasn't the recession fears, more of it was this liquidity issue coming out of Japan. And when you have something that is, because of market dynamics and not necessarily related to the values or fundamentals of companies, not to say that there aren't issues there, but that's not necessarily the full extent of what triggered this, that there are some people who probably saw this as buying opportunities, that when their favorite stocks that they've been watching came down, that they were able to get in. So there was enough interest and support in terms of buying, whether it was the market indices overall or certain stocks, that they were able to absorb some of that extra selling pressure that we were seeing coming in as a contagion.
Carol, I hate to nerd out on details, but sometimes I get hung up on little things. Could you elaborate for the stupid among us what the Magnificent Seven is, these tech companies? You brought that up earlier. What is this?
So these are like the 7 biggest tech companies in the world. They're all the names that you know. It's Apple, it's Amazon, it's Google, it's Meta, formerly known as Facebook, it is Microsoft, it is, who am I forgetting here, NVIDIA and Tesla. So these are these huge tech companies that have absorbed, lots and lots of capital, many of them on the backs of the idea that AI is going to be this huge, productivity revolution, and that these companies are going to have an outside benefit and it's going to shape the economy. And so all kinds of money has gone into these companies, and that is really what has been carrying the market up. We haven't seen as much of a broad-based increase in the market as I would like, kind of spread out among stocks. It's been very heavily concentrated in these stocks, which if you're investing in the indices, you're getting exposure to as well. So that has been bringing up, the S&P 500 and the NASDAQ and the like. So that's they've gone up, but they've also, as I said, in recent weeks here, lost some of that value, given some of that back. And again, I don't think it's necessarily because any one of these companies is a huge concern. I think it's more because the valuations and the exuberance got ahead of themselves.